Hello, everyone. My name is Laura Paglia. I'm President and CEO of the Investment Industry Association of Canada. The IIAC is a professional advocacy center. Through proper research and careful consideration, we provide thought leadership that encourages smart policies for competitive and healthy Canadian financial markets. A healthy financial market should bring benefits to everyone, from the individual investor to the largest of financial institutions. The declining listings on Canada's public stock exchanges have been raising alarm bells for market experts. We are joined today by one of those experts, Thomas Kalafatis. Mr. Kalafatis is the managing partner and founder of Hullwright Advisors, specializing in advising platform business models, fintechs, and new venture creation on strategy, corporate finance, and policy. He was the global head of equity execution and prime services brokerages at CIBC Capital Markets. And prior to his time at CIBC, he led the reform of the TSX's market-making system as vice president of sales and trading. He is a chartered professional accountant with an MBA from the Ivy School of Business. We are fortunate to have Mr. Kalafatis here with us today and as an advisor to the IIAC.
Thank you, Laura, for the kind words and introduction. Just want to add something quick there to that. I started my career at Burns Fry 30 years ago in the mailroom, and I view my work here at IIAC as coming full circle in that experience, as over those years, I had the opportunity to work with many senior people who helped and advised my career over the years. And it's really the only business I know. It's the only industry I've ever worked in. Never worked in any other business and just worked my way up the old-fashioned way. And it's an industry that affords that opportunity. It's very near and dear to my heart. And I want to help the industry continue to provide those opportunities for the next generation of Canadians.
We're very fortunate to have you as an advisor to the IIAC. And as an advisor, you recently published a paper entitled Re-Energizing Canada's Public Equity Markets, where you explore the reasons for what is described as the hollowing out of our markets, why it matters, and how we can fix it. So in your paper, you set out that the number of companies listed on the TSX has fallen from 1,486 in 2008 to only 747 in 2023. So it's a big 50% decline in 15 years. Canadian companies are opting to sell to foreign buyers and leave the country rather than to go public here. So in a nutshell, why does that matter?
Well, Laura, one of the opportunities in having this conversation is that we can share some thoughts that we did put in the paper. It was quite long, and apologies to our readers who maybe suffered from the whole document. I take an even longer term perspective, and that's why I mentioned I've been in the industry 30 years, and I started in the early 90s at Burns Fry. And back then, why I fell in love with the business is you actually had a number of exchanges across the country. You had an exchange in Vancouver. You actually had one in Calgary. Montreal was trading equities at the time. You had Toronto as well. You had dually competing options exchanges. It was a very vibrant market. It was quite fascinating for a young man to look at the business. And after 30 years, and you see the result of your life effectively in the business and see where it is, you say to yourself, well, how did we get here? And if we continue on this path, what does the market look like in another 30 years? And I guess what I would say, why does it matter, is 30 years ago, the markets provided an opportunity for all Canadians. It provided an opportunity for effectively anyone who wanted to invest in our economy directly could do so. And that's a very, very powerful statement to make. If you reduce the number of publicly listed companies, you could end up looking like markets overseas that might only have a couple hundred issuers. Some of the smaller Eastern European markets are like that. Some of the markets in Scandinavia are like that, where you don't necessarily have the opportunity for a broad-based participation by the public in all sectors of the economy. So you have a reduction in the opportunity to participate in the growth of the marketplace. You consequently would also have a reduction in the opportunity for people to participate in funding those companies, acting as agents for them, raising capital, providing capital, and really an industry that is the kind of business where you didn't need to have money to make money. You could literally just with brains and hard work participate in the business, and with perseverance and diligence, a willingness to learn, a willingness to be humbled by the markets, eventually make a name for yourself and create wealth for yourself. If we don't have a vibrant equity capital market, that's an opportunity, an industry that isn't going to be available for our children and their children. Furthermore, the actual companies themselves suffer from not having local agents and local interest in being able to fund their futures and creating opportunities from them. And so I suppose I'm looking at a very long-term trend, and I feel that over the last number of years, the vibrancy in our markets declined somewhat, but it's not too late. And with some energy and some thoughtfulness and a coalescence of mutual interest, we can turn things around.
So, Thomas, what would you say to those that say that the scarcity of these IPOs is global? It's nothing in any way specific to Canada. Is that an acceptable explanation for what you've seen here as a long-term trend that can be turned around?
I recall in the days when I was at a marketplace operator, one of the things we were most proud of was that Canada truly did punch above its weight class in the global capital markets. One of the first economies to launch ETF structures, index products. Our market share of global capital markets volume and value was higher than that of similarly sized economies like Italy or Australia at the time. If you look at the vibrancy we had, it was endogenous to the strengths that Canada asserted in the marketplace. And no, I don't think it's acceptable to say that Canada needs to suffer along with the rest of the world if the rest of the world is making poor decisions. Yes, it's true that there's been a dearth of IPOs globally. I read a statistic recently that mentioned something to the effect of that 70% of the world's market capitalization of public corporations now in the United States. There's some cryptocurrencies that literally have market caps or theoretical valuations that are, greater than 90% of our public companies or public companies globally. That's not necessarily, that's, for lack of better terms, an excuse or a way for people to describe away a problem without actually solving the problem. My point would be Canada has proven the ability to punch above its weight, has been competitive in the past, and with the talent and capital and strengths that we have that are endogenous in our own comparative advantages, we can be punching above our weight again. So what it requires is a competitive spirit and a desire to do so. And it is a globally competitive market. And we need to remind ourselves every day that if the Canadian markets have to be better than the Australian markets, they have to be better than the American markets. There were many innovations even 10, 15 years ago that, again, Canadian markets did first, and we could see it in our interlisted market share. We were more competitive, so we were gaining market share. It's a constant battle, and it can't stop. So to say in any business, whether it's the restaurant business, transportation business, any industrial or consumer product business, to say, well, our volume's down because everyone else's volume's down. Well, that may be true, but it's not a recipe to stay in business. And I'm here to, assert a confidence that if we've done it in the past, we can do it again.
Thomas, you've mentioned a few times the U.S., our neighbors to the south. How would the proposed U.S. tariffs impact the good news story that you see could be forthcoming?
Yeah, so it's interesting. When we wrote this paper, as you can imagine, these things take some time. And one of the challenges is by the time you finish writing half the draft, the reality on the ground changes quite often. One of the points we made in the paper was this concept that our industrial policy, our trade policy, our investment policy has been around the concept of free markets, global markets, free trade, free flow of capital. Those are, somewhat bedrock principles of capitalism. But we did point out that, on a practical level, if one makes the assumption that when one participates on that basis that we're going to have free markets, liberal global markets, and it assumes your counterparty is going to constantly behave that way. But if your counterparty changes their mind, you risk having challenges repatriating your capital exactly when you need it. So, a lot of ink's being spilt on the tariffs. I'm sure much more will be spilt. My concern isn't necessarily solely on tariff barriers to trade, which generally harm the efficiency of goods and services markets. But I also see a trend to non-tariff trade barriers. And that concerns me a lot more. There are a variety of mechanisms in our securities industry regulations, in American securities industry regulations, that are a result of the unique and special relationship that Canada and the United States have developed, frankly, over 100 years since the SEC Act in the 1930s. Everything from how our securities are cleared and flipped across the border to how initial public offerings or other financings are registered across the border, accounting reporting mechanisms, and we've effectively created a large dependency on these mechanisms, and we take them for granted. And we need to ensure that those mechanisms continue to work for us in a positive manner. And that's what would concern me. And escalating what I would like to see as a de-escalation in some of the rhetoric and tensions. And obviously it's a tough negotiation, and that's part of the negotiation process. But a de-escalation is necessary because of that dependency. And our cousins to the south have demonstrated a willingness to use non-trade, non-tariff barriers to trade.
Your reference to our large dependence on mechanisms with the U.S. that are taken for granted. Could you expand on the non-tariff barriers to trade, and in particular, Canada's role in that regard? Is there anything that we could or should be doing differently?
Yeah, I'm not sure there's something we should or could be doing differently at this moment, specifically right now, but we should be aware and be developing alternatives to how things may evolve. For example, if one looks at the makeup of how capital flows happen across the two borders, I mentioned earlier, we have a very unique relationship between our clearinghouse, CDS, and the U.S. clearinghouse, DTCC, where effectively interlisted securities trade north-south. I can buy in New York, sell in Canada. They effectively trade like water. We have extremely liberal, open, direct market access rules, which effectively allow American participants to make markets for, I would gather, probably more than 50% of the liquidity on our exchanges is made by American entities, and that's again a result of the special relationship between the two countries.
Speaking of access to U.S. markets, you were very successful during your time at CIBC in opening up that access for the benefit of Canada and your firm. Currently, has anything changed by way of differing rewards and incentives?
A good question. I think where you're going at is you might be highlighting I'm sort of potentially contradicting what I'm saying, contradicting past behavior. And I guess what I would say is business decisions or decision ones make are within a strategic context at a moment in time, okay? And there's a difference between doing things right and doing the right thing. At the time, and we're going back 20 years, Again, global markets were liberalizing. The trend was toward liberalization of trade, free flows of capital. And the right thing to do at the time was to open Canada to the world and bring the world to Canada. And part of that was to create mechanisms, whether they were based on technology, regulation, client service, good people, deep knowledge of markets, and assist those participants in coming to Canada. Those decisions were made 20 years ago based on a context of time. And I'm not saying we're there yet. Perhaps we will continue to have free flows of capital and a system where that's necessary. What I'm trying to highlight, though, is that we need a game plan. We need to be aware that if this changes, and many economists are writing about this sort of return to mercantilism, a return to a more statist global economy where nation states favor their parties and their domestic participants over the liberalization of trade. If that was the case globally, then we need to think about what is the right thing to do to protect our markets. I note that in your, the title of your organization is the Investment Industry Association of Canada. And what is the right thing for Canada to do if the rest of the world is raising barriers? Are we going to allow for the continued export of capital?
In Re-Energizing Canada's public equity markets, you flesh out and explain, along some of the lines that you've described, the root causes for what you describe as a hollowing out. One of those root causes are the fixed costs for intermediaries and issuers, and in particular, the cost of labor. In the current context, what do you see happening with labor costs?
Yeah, that's a good question. And again, to be precise, it's not necessarily the absolute cost of labor that matters. It's the form of compensation in the industry. So our industry is based at its core on an intermediation of risks. And when it comes to the creation of new securities, the formation of new securities, whether they're in the primary or secondary markets or secondary offerings, is a very risky endeavor, okay? Investment banking, corporate finance is an exceptionally difficult job, and it needs to be rewarded. Why? Because effectively, one has to merchandise companies for the public market. And if one thinks about what that means from a risk perspective, one would need to find the type of company and survey hundreds of companies to find a company that's ready for the public market. They have to survey to make sure that not just the company being financially ready, but that its house is in order. So there's a whole due diligence process. The company needs to be marketed. It needs to be priced. At every step along the way, there's an opportunity for failure. There's exceptional sequence risk in the business. And because of that sequence risk, it's difficult to guarantee high fixed forms of compensation. And that's why this business has always been a success-based business. There's been a reward on success, and through fees, commissions, underwriting, and effectively, that success-based competition creates the incentive because it's high enough for further search of opportunities. When the balance of fixed cost to variable cost changes, it now becomes riskier for the company that's underwriting, not necessarily the company, but underwriting the labor that's seeking those underwriting opportunities. And, our view is the fixed costs of being in the business have potentially risen to a point where entire searches, the opportunity cost of entire searches is too high to look. And the industry can't take the risk of the search. And so the search isn't happening. the search for the merchandise that the general public might seek to invest in.
And so we incentivize the search through variable compensation.
Effectively, that's how the industry worked in the past, and over time, the cost structure of the brokerage community has shifted from a high variable compensation, low fixed labor cost to now added costs, where you have very high fixed technology costs, overheads, very high regulatory overheads that are fixed in nature, and if one were to think about the mix between fixed costs and variable cost, now only the largest deals can reward the search enough to allow a brokerage firm to continue to maintain and sustain that business. So it's really the mix between fixed and variable costs.
Many people think investment bankers are simply overpaid and may be somewhat off-put by what you've described as their entitlement to large comp. What would be your response?
Yeah, I just fundamentally would disagree with that. And that's not me talking my book. I'm not an investment banker. I was more on the secondary trading side of things. But as someone who's participated in the business for 30 years, I can tell you it's an exceptionally difficult job for the merchandising reasons I mentioned earlier. And the skill level required. You have to understand business, you have to understand economics, but you also have to be understanding of your client's needs, sales. You have to have a lot of nerve. It's a very multifaceted, multi-talented role with enormous risk. And, again, it's my opinion, but they deserve every penny they earn because they've earned it through the risk they take. And in a society where we want to reward people for risk, which effectively is what business is all about, they're in one of the toughest businesses in the world. And jealousy around compensation isn't productive. And I think a recognition of their talents is more constructive.
In the context of what you've described, you mentioned regulatory overheads, and we hear a lot about the cost of regulation. Your paper properly recognizes its importance. That we need it is indisputable, and it provides two very real-life examples of how regulation costs might be differently addressed. Going through them briefly, the first example, curiously, is the actual going public of the Toronto Stock Exchange itself. And since we're talking about their declining listings, what did we learn from them going public? And what do we do with those learnings?
Yeah, and I think the focus is on learnings here. I've been fortunate enough to be on a number of sides of the table, both at the marketplace operator, at larger firms from a capital markets trading perspective, and then at smaller firms looking in the financing and issuer side of things. And that perspective comes with time. And again, going back to something I said earlier, which is decisions are made at a moment in time based on the strategic context in which the environment exists at that time. And at that time, exchanges around the world were going public. They needed more capital to invest in their technologies and to modernize. And effectively, we created a variety of regulatory trade-offs, let's call them, where they were allowed to, exchanges, and I'm speaking generality, were allowed to go public, but they couldn't regulate themselves. So we separated as an industry the regulator from the exchanges, where in the past, let's look at, the New York Stock Exchange in the 1930s would regulate itself. In a modern world, the idea that would happen is anathematic to even the most libertarian of financial people, that one would be an exchange would be allowed to regulate itself. So you have to create some of these separations, but some of these regulatory sort of maneuvers, let's call them, or recognitions, rules that were put in place made sense at the time. One that sticks out to me is the non-trade regulatory subsidy of alternative trading systems, right? They can't allow a monopoly or what's perceived as a monopoly to go public and sustain its monopoly. So the regulatory environment created the concept of trade through rules and price protection and this sort of thing, and the requirement that new ATSs are connected to. And, that's been 20 years ago. Do we still need that, right? Another example is the exchanges effectively have, again, from a strict economic perspective, monopoly rights over their data. Many arguments that the data that they consume is actually passed on to them by the quotes of the brokerage community. So who really owns that data? Well, legally, it's the exchanges. There's no argument there. But one could ask themselves, in an environment where trading fees used to be 2 times the price of data fees 15 years ago, but now the average broker-dealer is probably spending 4 times on data than they are on trading fees. This is a perfect example of an escalation of fixed costs. And I think in the paper we literally highlight, somewhat deliberately and for effect, that the concept of the data fee increase in the business is probably equivalent to the bonus pool decline in the business, right? And as you increase fixed costs in the industry, you reduce incentive to create new issues. And this is a perfect example of, short-term versus long-run incentives, right? Where in the short run, a public entity wants to grow its earnings. It's easy to create new data products, new forms of intermediation. But in the long term, if one doesn't have issuers to sell data on, it's a self-defeating strategy. And so our view is, maybe it's time to consider making the Toronto broadcast feed a public good, and just, the exchanges are allowed to enrich, enhance, sell any package of data they want, but perhaps the raw data should be in the public domain, and those that want to invest in their own mechanism to manipulate it can do so. And, where's some of the precedent in that? Well, common carrier rules for transportation. You have similar type regulation around, telephony and telecommunications. It's an open access type system because it's recognized as a public good. And perhaps we should recognize that the raw data that comes out of an exchange is a public good.
Thomas, making the raw data part of the public domain, wouldn't that cause financial harm to the exchange?
Well, arguably, there's been a lot of literature written about how exchanges are effectively operating systems, okay? An operating system doesn't necessarily have to be on your computer, but it's a set of rules or mechanisms that people operate on. So the industry operates on a set of exchange rules and regulatory principles. And operating systems that are more open attract more development, more interest, per se. And my favorite example would be many years ago, the Toronto Stock Exchange had a proprietary protocol for access called STAMP, and that was replaced by the international protocol called FIX, which was a more open protocol. And that was critical in opening up the exchange to global participation, because now we spoke the global language of finance from a computer perspective. I would argue if the exchange were to open up its broadcast feed, and perhaps even voluntarily make it public domain, they would dramatically reduce the noise around market data by basically saying, look, you can manipulate some of this stuff because we'll give you the raw material free, but free is never really free, because now the organizations will have to figure out how to manipulate it, scrub it, clean it, put it in their systems. That has a cost. And the exchange could demonstrate that it competes very well on that cost. It would attract more interest and probably new participants who are buying their enriched product or creating new services around that feed. So I actually think they might find they make more money by making what's effectively a very low value raw material into a more sought after commodity by making it a public good, no different than in the computing world where you have Linux and other public domain issues, or even In the AI space, you have a number of participants talking about making the models open. Openness is a good thing. And as long as they can demonstrate competitiveness in their sphere of expertise, I think it'll actually make them more money, and it'll be better for Canada as a whole.
So thank you, Thomas. You've been using the word public a lot. Public funding, public good, public equity. What do you say to those that say private capital is providing a full and complete substitute?
Thoughts are somewhat irrelevant. The data can demonstrate that the growth of private equity has been quite phenomenal from the 80s forward. Indisputably, there's a large, going private mechanism that's contributed to the reduction in the aggregate number of listings on all markets globally. But again, I would contrast that to the statement I made earlier around Canadian competitiveness, okay, and Canada's competitiveness against other global marketplaces around the world. The private capital sphere is its own sphere. It has its benefits. It also has its cons. You don't have the benefit of liquidity in a private capital environment. There's tremendous value in liquidity. There's a reason why founders want the exit, and not just for the payday, but for the liquidity. It's very hard to borrow against private stock. You can't, the old term is you can't eat private stock, you can't borrow against it. Where a public security, you can lend, you can borrow against, you can trade, you can sell, you can buy back, you can put in your RSP. There's a lot of things you can do with a public security you can't do with a private security. And the goal shouldn't be to compete or displace private capital. It's part of a process where, let's think about how a small business evolves. I've been involved in startups. You start a small business, you grow, you raise some maybe you self-fund it through friends and family, you raise some outside capital, it grows some more, you get to a certain scale, and then you seek to go public to offer the investors who invest in you liquidity. Where I think the opportunity would be to create a new form of security or recognition of reality, really, quasi-private security. And you're starting to see platforms in the United States around crowdfunding, which is illegal here in Canada.
Thank you, Thomas. If you could complete this sentence, it's a public good because
we all benefit from its existence and its success. We all benefit from it because we have a lower cost of capital. Our companies have a lower cost of capital. We have access to investment opportunities, even those who don't participate in it, because they'll work for a public company, or they'll have a spouse or a family member that works for a public company, or their pension plan invests in public companies.
Well, Thomas, thank you for joining us, and thank you for writing Re-Energizing Canada's Public Equity Markets. Its honesty, depths, and suggested solutions are important to smart, beneficial policies for Canadians' financial markets. Thank you.